the challenging thing about, well, the nice thing about, because of course I'm recording from my house. The challenging thing is I've got a 2-year-old. So when we take a break, then he sees me, then he is glued to me. And it takes negotiations to try and pry myself away from him. So yeah, apologies that I come back. I came back late. I had to negotiate my escape. I had to negotiate my escape from him. Okay, all right. So the other thing just to consider, of course, when you're looking at things like supply, is that you need to consider whether you're dealing with a zero-rated supply, dealing with an exempt supply, and so forth. But effectively, that's what when you have to charge VAT, these are the things that you need to consider and look at the different sections and subsections within those sections to ensure that you're comfortable with how you determine VAT. Right. So if I go back then to the slides, so we've had quite a bit of a discussion. So I will try and I'll pick up the speed, of course, not that even that I will pick up the speed as we are going through these so that we ensure that I cover as much as possible in terms of what we did not speak about. Okay, so in terms of taxable and non-taxables, of course, anything that is subject to Section 12 of the VAT Act, which is an exempt supply, will then not be a taxable supply. So that's a non-taxable supply, whereas everything else is a taxable supply. So, and the other thing to consider, of course, and become comfortable with is that anything that is subject to Section 11, so remember Section 11 is the zero rating section. So anything that is zero rated is still considered to be a taxable supply. That is why the most ideal situation that you could find yourself in when it comes to the VAT legislation is that you are making zero rated supplies only. Because what's going to happen is that you are not going to charge any, well, you're going to charge VAT at a rate of 0%, and you'll be able to claim all of the input that you've paid. Okay, so there's no amount ultimately that you'll be liable for. You'll be required to pay over to SARS, and all that's going to happen is that you are then going to be making claims on a periodic basis for the input that you paid. Okay. Right, so we've spoken about these, and I've spoken about Section 7, in terms of looking at Section 7, supply, vendor, goods, enterprise. So I've spoken about these, so I'm not going to spend time on these slides. We've spoken about a vendor, what it means to be a vendor. So again, I won't spend much time on that. The only thing is just to highlight in terms of the requirements. So again, you're required to register as a VAT vendor where you're making taxable supplies exceeding 1 million. Okay, so it's either you've made the taxable supplies exceeding 1 million, or you're expecting that in the following 12 months, you're going to make taxable supplies exceeding 1 million. And in that case, then you'll be required to register as a VAT vendor. Whereas if you do not meet the threshold, so the 1 million threshold, you can still register, but on a voluntary basis. So it's not a requirement. You can still register on a voluntary basis. Okay, so and then that voluntary basis, of course, is 50,000 rands. It's the minimum. Okay, so if you're making supplies exceeding a 50,000 rands, then you can register as a VAT vendor. And then the other thing just to consider is that if you are running branches and you want to register each branch as a separate VAT vendor, you are allowed to do that, to register each branch as a separate VAT vendor. However, in order for you to register each branch as a separate VAT vendor, one, they must have their own independent accounting system. Okay, so they must have their own independent accounting system. And two, they must be separately identified by reference to the nature of the activities that they carry on. Okay, so you need to be able to identify the activities that they undertake separately from other branches or divisions. And in that case, then we'll then say, okay, fine, we can separate the two, and you can then have a branch or a division being accounted for as a separate VAT vendor. Okay. Okay, so that's vendor, goods or services. So we've spoken about that. Enterprise, we've spoken about that. Okay, so I'm not going to spend time on that. Let's talk a bit about the importation of goods. Now, we looked at section 7.1a, which says to us we must impose VAT on the supply of goods. But section 7.1b says to us, if we import goods into the country, VAT will be imposed on those goods that are imported into the country. Okay, so if we import goods into the country, VAT is going to be imposed on those goods that are imported into the country. Now, what's the purpose of imposing VAT on goods imported into the country? Is to try and level the competitive field with suppliers from overseas. What do I mean by that? If a t-shirt is produced in South Africa and that person has to account for VAT, that means that t-shirt effectively is going to sell for 115 rands in South Africa. But if I go to China, where they don't have the South African VAT, another supplier will sell me that t-shirt at 100 rands, which means I can go to China and buy it for 100 rands, because in South Africa, I know that it's going to cost me 115. Okay, so you can see things will then be cheaper in China compared to what they are in South Africa. So that is why then what then happens, as a declaration, this is just water. Okay, if you can see on the inside, it's clear, it's just water. There's no other substance in there other than H2O. So if we go back to, if those goods are being purchased from China, or that t-shirt, then of course I'll purchase that 100 rands t-shirt compared to the 115 rands t-shirt. In the past, the example would not make sense, because then somebody else would then say, nah, but you know what, if I buy the goods in China, then that means I must also book a flight to China and go and buy the goods in China and bring them back to South Africa. Yes, in the past that would be the case, but now things have changed. You do have, you can sit in South Africa and order goods from China, and they will come to your house. So it has become even more prevalent that goods are being imported into South Africa. And so therefore, this is very important, that those goods that are imported to South Africa are then charged with VAT. So as an example, and my people who do their shopping on, for example, on Shein, or I think the other one is Yellow Submarine. I mean, there are quite a number of them that are online. Remember, those suppliers supply those goods, and they're not resident in South Africa, or they're not in the Republic. So when you are ordering goods from Shein, you are importing goods into the country. And because you are then importing goods into the country, you are then subject to this VAT of 15%. Okay. And of course, you've heard the discussions before where somebody says, no, I've just cleared my cart at Shein. And then Shein then sends you a message saying, oh, by the way, yes, thank you very much for buying at Shein. Please note that, of course, there's other amounts that are payable to authorities in South Africa. Okay. Then somebody orders things worth 600 rands, and then they get the shock of their lives when they have to pay let's say an additional 500 rands, and there's an example, to that, in addition to that 600 rands, in order for them to get those goods. Because one of the things that get paid for, of course, is the VAT that gets imposed when you're importing goods into the country. Okay. So in an instance where you're importing goods into the country and those goods are coming from the BLNS countries, so Botswana, Lesotho, Namibia, Swaziland. So if goods are coming from any of those 4 countries, it's a simple calculation. It's the value of the goods multiplied by 15%. Okay, and we say it's the customs duty value. Generally, the customs duty value is equal to the value of those goods, especially if you've paid cash for those goods. Okay, so the customs duty value would generally be equal to the value of those goods, which is what you paid for those goods. In a case where the goods are not coming from the BLNS countries, but they're coming outside of the BLNS countries, then there is a more comprehensive formula that gets used to determine the amount of VAT that is calculated. And that amount of VAT, of course, is based on, one, the customs duty value. So you then say, what is the customs duty value? And to that customs duty value, you're then going to add 10% of the value of that customs duty value, plus if there are any non-rebated customs duty payable or any import surcharges, you are then going to include that in there as well. So that will then be your formula that you are then going to use to calculate, and then of course multiply by the 15%. So it's the sum of those and then multiply by 15%. That will then be the VAT that will then be paid on those supplies. Okay, and if you've probably seen or you've not seen in the past, what usually happens is that VAT, of course, let's say you are using an agent to clear your goods into the country. So the agent, when they're invoicing you for their services, they'll also include that VAT as part of the amount that you need to pay them, because the agent is the one, when it gets to be it at Durban Port or be it at OR Tambo when the goods land, and they need to be cleared at customs, the agent will pay that amount on your behalf. And that's why then they then invoice that amount back to you, because ultimately they were just acting as an agent on your behalf. They're not the ones who are ultimately liable for that VAT. Okay. Now, why do we pay this VAT? We pay this VAT, as we said, to level the playing field, but goods will not be allowed to come into South Africa if this VAT is not paid. Okay, so if this VAT is not paid, those goods will never be allowed to come into South Africa. Now, I'll take you a step back to when we started with VAT. Remember, I said that VAT is a consumption tax, meaning that VAT is driven by where does consumption take place. Now, if the goods are not allowed into South Africa, then that means consumption can never take place in South Africa. Okay, so you're not willing to pay the VAT. And because you're not willing to pay the VAT to let the goods to allow authorities, well, for the authorities to allow you to bring the goods into the country, then consumption of those goods can never take place within the Republic. So that's why, for your purpose, it's important that when you're looking at the importation of goods, you first say the initial VAT in order that allows the goods to come into the country, was that paid? If the answer to that is yes, you say, okay, tick. That means the goods are now in South Africa. Now that the goods are in South Africa, you then say, where is consumption going to take place? Okay, so we then say the consumption is going to take place in South Africa. Now, because the consumption is going to take place in South Africa, what do we then say? We then say, okay, fine, that VAT, which we paid in order to allow the goods into the country, you will be able to claim that as an input deduction. So you pay it to have the goods come into the country, but you're also allowed to claim it as a deduction, as an input VAT deduction, of course, to the extent of your taxable supplies. Okay, so you can claim the input, but to the extent of taxable supplies. Okay, so that would be to the extent of the taxable supplies. And then over and above that, when you then supply those goods to a third party, you will, in South Africa, you will then be required to account for output again, which is normal, a normal situation. You have made a supply and therefore account for output on that supply. Okay. Any questions? Importation of goods.
So my question is rather on input tax that is claimed. Will it be to the extent that payment is made, or a portion, or calculated on the portion, the input tax that is claimed?
Claimed on the importation of goods.
Not necessarily importation of goods, but then generally, do you have to, like, what's this? Apportion it?
You have to apportion to the extent of your taxable supplies. That's all you need to do, to the extent of your taxable supplies, not to the extent of what you've paid.
Oh, okay.
Yes. Okay, so this one we've gone through, so I'm not going to spend time there. Zero-rated supply is just a quick one. We know that there's certain goods that are zero-rated supplies, and it's dealt with under Section 11 of the VAT Act. And so generally anything that gets exported out of South Africa is a zero-rated good. They can either be a direct export or indirect export. I think the key thing about exportation is that whether it's direct or indirect, it does not matter as long as the goods have left South Africa and you've got the documentary proof that the goods have left South Africa. I think that's the key thing when it comes to exports. The goods have left South Africa, whether you have directly exported or you have indirectly exported the goods. And then when it comes to the supply of fuel, okay, remember that supply of petrol or diesel is a zero-rated supply, and the reason for that is because there are other taxes that are included in fuel. So that's why it would be a zero-rated supply, and things like basic foodstuffs, they are zero-rated supply, because the reason why they'll be zero-rated supply is because the government is trying to provide a relief to certain groupings. So if you look at the supplies that are included as zero-rated supplies, so looking at things like brown bread, maize meal, milk, fruits, as you can see, these are basics. Although, and this is more of a philosophical / political discussion around these things, where, for example, if you look at things like, because there's been a discussion around maybe we need to remove things like brown bread, milk, fruits and vegetables from this listing. And the reason for that, it's saying that in absolute terms, these type of things are benefiting people who are of a higher standard of living, and not necessarily what this was aimed at, which is what was at a lower LSM. And the reason for that is because, yes, the lower LSM spends a big portion of their total income on these foodstuffs. But when you're looking at the absolute quantity of, or the absolute rand value of what they're spending, when you compare to the upper LSMs, it's actually lower. So ultimately, the person who walks into, for example, buys a loaf of bread for 20 rands or 30 rands, depending on that loaf of brown bread. The person that buys liters and liters of milk on a monthly basis, that buys tons of fruits on a monthly basis, is the person that is actually, when you look at the absolute rand term or the rand value, is the one that is benefiting the most from this provision. But in any case, that's more for a philosophical, political discussion and not necessarily for our purposes. Okay. And I think the other thing which is quite good that has been included in those zero-rated supplies is the supply of sanitary pads, where there's no VAT that is imposed on the supply of sanitary pads. Okay, so that's also included in that listing. Okay, so here it's just about obtaining the proof of, so I'm not gonna spend time on that because we are really running out of time when it comes to VAT, because I still want to talk about other things. All right, then let's then look at value added tax in terms of sale of a going concern. Now, when I'm looking at the sale of a going concern, you will see the principles are the same as when we're talking about the change in use. You'll see the principles are the same as when we're talking about the change in use. So when you're looking at this, you will see the change in use principles will then come through. So what is the sale of a going concern? So the sale of a going concern, of course, will be where a person sells a business. Okay, and you're selling a full business, and that business, when it's being sold, the other person would acquire it and continue running it. meaning that all the necessary equipment and all the resources that are required in order to the business to be run have been a part of the sale agreement. Okay, so everything that is required in order to run that business is part of the sale agreement. And because that's part of the sale agreement, that means the other person can then run that business as a going concern without needing to make drastic changes to the business. Okay. Why is this important? Because a sale of a going concern is zero rated. Okay, so the sale of a going concern is zero rated. But in order for the sale of a going concern to be zero rated, there are certain requirements that need to be met. And those requirements that need to be met are requirements in terms of section 11(1)(e). Okay, so as you can see, we are under section 11, which means we are dealing with zero rated goods. So we are then saying section 11(1)(e) is the section that then deals with the sale of a going concern. Right, so what are these requirements? Number one, both parties to the transaction must be VAT vendors. Okay, so both parties to the transaction must be VAT vendors. They have to agree in writing. So it's very important. It has to be in writing. It cannot be a verbal agreement that I'm selling you a going concern. It has to be in writing that this is a sale of a going concern. Okay. Number three, they have to agree that the enterprise will be an income earning activity on transfer. So what do we mean by it will be an income earning activity? It means that all the assets necessary to continue the business will be transferred. If there were contracts that were in place, all the contracts that were in place will also be transferred, meaning that it will continue to be an income earning activity after the transfer. Okay, and then the next thing is that the assets necessary for carrying on such an enterprise are part of the disposal. Then they need to agree that the consideration for that supply is inclusive of VAT at a rate of 0%. So they need to agree that this is a zero-rated supply. Okay, so they need to agree that this is a zero-rated supply. Okay, so now that we are happy that this is a zero-rated supply, let's then look at what are the tax implications then when you sell a going concern. So there are three scenarios that we're going to look at. These three scenarios are if the taxable supplies are at 100%, if the taxable supplies are less than 100%, or let's say less than 95%, but more than 50%, then the last scenario we're going to look at is taxable supplies that are less than 50%. Okay, so we've got three scenarios that we'll deal with. So let's start with the first one. So remember that if you're making taxable supplies of 95%, you are deemed to be making taxable supplies of 100%. Okay, so remember that you're making taxable supplies of 95%, then that means you are making taxable supplies of 100%. Okay, so then if we then look at this, we then say, okay, fine. Let's then start off. If we sell a going concern that is making 100% taxable supplies, we're going to look at this from the seller's perspective as well as the buyer's perspective. So that's something to remember, looking at it from the seller's perspective as well as the buyer's perspective. So let's start off with the seller. So the seller is making a supply, which means they need to account for output. Now they will then account for output, and the amount of VAT that they will account for is nil rands. Okay, it's very important for us to be happy and be comfortable with the fact that VAT that is applied at 0% is still VAT. Don't use your mathematical brain. Use your, I'm going to say, use your lawyer brain. And your lawyer brain should say there is output VAT that has been charged on this transaction. It was charged at a rate of 0%. But it was charged. So there is output that was charged. Then similarly, when it comes to the input there is input of nil rands that can be claimed on this transaction by the buyer. Okay, so ultimately, mathematically, you look at that and say, but it's nil rands, therefore, we can't say there's output there, but there is output. It's just that it's nil rands. Okay. Now, that one is easy. Buyer, 0. Seller, 0. Easy enough. As long as all of the requirements are met that we discussed in this previous slide. Now, let's look at an instance where more than 50% of taxable supplies are made. Okay, so we're less than 95, but we're more than 50%. Now, if there is a supply that is made of a going concern, then VAT should be charged on the sale. So we're looking from the seller's perspective first. So let's look from the seller's perspective first. So we're then going to say, okay, the seller has made supplies of a going concern. Okay. And remember, the one thing you need to remember is that from an output perspective, the general rule is that you are not allowed to apportion output VAT. Okay, so the general rule is that you are not allowed to apportion output VAT. And there are 3 exceptions to that. And those 3 exceptions to that would be: 1, if as an employer, you supply a fringe benefit to an employee. Remember this, if you supply a fringe benefit to an employee, that fringe benefit is deemed to be inclusive of VAT. So there's output that must be accounted for by the employer. However, the employer is then allowed to apportion that output to the extent of their taxable supplies. So that's the first exception. It's to the extent of the taxable supplies where there's a fringe benefit being supplied. The next exception would be in an instance where there's an indemnity payment. So where there's an indemnity payment and there's output on that indemnity payment, then the person receiving that indemnity payment will be entitled, well, will be required to account for output, but they will account for that output to the extent of the taxable supplies. Again, the third option is what we're going to discuss as well here, is that where you are selling a going concern or you're selling a business, and that business is making taxable supplies that are less than 50%, then you are allowed to apportion the output on that transaction. Okay, you'll see, we'll go through that. Okay, but other than those 3 exceptions, you are not allowed to apportion output. So other than those 3 exceptions, you are not allowed to apportion output. Okay, right. With that in mind, let's then continue. So we said there's a sale of a going concern and it's more than 50% taxable. It makes more than 50% taxable supplies. So then the seller must charge VAT at 0% on the full transaction. Okay, you're going to charge VAT on the full transaction at 0%. Now, what is then the problem there? The problem there is that, remember, if you are not making 100% taxable supplies, whenever you incurred an expense, you were only entitled to claim the input to the extent of your taxable supplies. Okay, so you were only entitled to claim input to the extent of your taxable supplies. And as a result of that, what you then see is that there is a bit of a mismatch. I'm going to refer to it as a mismatch between what you could claim as input compared to what you are now required to charge as output. because what you could previously claim as input was to the extent of taxable supplies, and what you are now required to account for output is 100% of the business. And as a result of that mismatch between 100% that you are charging for the sale of the business compared to only being able in the past to claim VAT or input to the extent of your taxable supplies, you know, because of that mismatch, the legislation then says, maybe we need to compensate you for that mismatch, where in the past you were only entitled to claim to the extent of your taxable supplies. I'm going to pause there. I'm going to pause there and ask if you're understanding what I'm saying, or I have lost you.
Yes, I think it makes sense on my side because when you would have what's this when you'd be making taxable supplies before you could sell, right? You made input taxes, but let's say you were having multiple not multiple you were having a portion that is taxable supply and a portion that was an exempt supply. So you'd maybe let's say claim input tax only on 50 percent. Now, when you have to levy output tax or reverse basically the input that you initially claimed, it will only be fair if it's on 50% and not the whole 100%. And I think that's where section 16.3H come in.
Okay, happy with that, yes. Because then section 16.3H then comes in and says, okay, fine. Now we're going to compensate you for all of the VAT that you previously could not claim. Now that you are making the supply of a going concern and we're saying to charge VAT on the full supply of that going concern, then we need to compensate you for the VAT that you previously could not claim. And how do we do that? So it's through that formula, A times B times C. So A being the tax fraction. So remember, tax fraction is 15 over 115. B, then it's the lesser of, it's the adjusted cost, or it's the market value in an instance of connected persons. So CPs means connected persons, or it will be the open market value on the date of the previous change in use. Okay. Or the open market value on the date of the current change in use. Yeah, so you look at that and then say, okay, fine. What is the, effectively, what is the, let's say there's never been a sale of a going concern, and this is the first time that there's a sale of a going concern. Then all you'll do, you'll then say, okay, fine. What is the open market value of the business when it was disposed of? And C, of course, is the extent of the exempt supplies. So this C that is here in the formula is to the extent of the exempt supplies. Okay, so if you take that formula, that's then the additional input that the taxpayer will be able to claim. Okay, so that's from the seller's perspective. Then from the buyer's perspective, they are charged input at 0% on the full supply. Therefore, they'll claim input at 0% on the full supply. Sorry, not on full supply, to the extent, my apologies, to the extent. My apologies, to the extent of their supplies, taxable supplies, which is what we're dealing with over here. So then, as the buyer, where we are not going to use the business going forward 100% taxable supplies, okay, there will then be an adjustment in terms of section 18 capital A. Okay, why that adjustment in terms of section 18 capital A? Because we don't have an intention of using the business to make 100% taxable supplies. because you acquired a business that was making 100% taxable supplies. And if going forward, that's not your intention on your side, then what's going to happen is that there's going to be a change in use adjustment, meaning that there's an additional output tax that must be accounted for. And that additional output tax that must be accounted for, how do we calculate it? We then say, what is the value of the going concern when it was sold? And then we then start stripping out certain things. What are those certain things that we strip out? So we'll strip out if there are any assets that will be used to make 100% taxable supplies. We'll then strip out those assets, because the reason why we strip out those assets, it's because those assets will make taxable supplies. So why should we then account for additional output on them? Because going forward, those assets are going to be making taxable supplies. 2, it will then be assets reduced by assets for which input VAT would have been denied. Okay, so remember, certain assets you would not be able to claim output. So not output, you won't be required to pay output, meaning that you also won't be able to claim input. So that's why now on this additional output that we are declaring, those assets would never be subjected to output anyway. So that's why we must then strip them out. Okay. And then what we then do is to then multiply by the non-taxable use percentage. So the only thing missing there then is percentage. So once we've calculated all of those values and summed them up, okay, we then use the non-taxable use percentage and multiply by that, and then multiply that by 15%. So that would be the additional output that the buyer will have to account for if their intention is not to use that business to make 100% taxable supplies. Okay, is that clear?
I have a question, sir.
Go for
Like,
it.
how does section 18 cap A differ to section 18.1? Because both of them, I'm seeing it's a hoodie dropping of taxable supplies. Like, how are they different?
So the only difference between them is that section 18 cap A, you will use it specifically for the sale of a going concern, whereas section 18 subsection 1, you will use it for any change in use. But they are exactly the same.
Oh, okay. Then it means I'm answered. And then since you say that normally 95% it's seen as 100% because of the de minimis rule, so when you're claiming input tax, you will be claiming your input tax on your full 100%, isn't it?
Yes.
And then when you now have like a change in use whereby you have to reverse that input tax, like applying your section 16, the change in use, the reversal of the input tax that you claimed, is it still gonna be on 100%? We won't have to be looking at whether it was fair or not because of you claimed the whole input tax, right?
So if you are reducing from 100% to 0%, then yes, you would have to reverse the VAT from 100% to 0%. But remember, there you're not reversing. Well, effectively you are reversing input, but how you reverse that input is by you declaring output under section 18. Let's say section 18 subsection section 18 cap A, if it's a sale of a going concern.
Yes, sir, I do understand that. Agree, like initially now what we had was if you were having the reason why we brought section 16.3H, it's because we would have like a 50% taxable supplies, but then when we reverse the whole thing, we would have like 100%. Therefore, we have the 16.3H coming in to say that, but it's not fair because of we initially did not claim input tax on the full 100%. So now what I mean now in the 95% that we have, so from the get-go, it was 95% taxable use, but then we would claim input tax on the whole 100%. So therefore, 16.3H will not apply. That's what I'm asking.
No, I am so confused by your example, eh? I'm not following what you're trying to say.
Can I put it? So the example that you're making, you said we are making 50% taxable supplies, right?
Yes.
Now we are, maybe let's say we are changing in use or something is happening. Then we would be reversing the input tax that we had claimed on 50%. But then we will be reversing the whole 100%. That is why the section 16.3H is coming in to say, but then we can't be levying output tax on the whole 100% when we only claimed 50%, right?
Okay, so let me see if I understand you. You are saying to me I'm a business that is
Yeah,
making 70% taxable supplies.
yes,
Okay? That business gets sold to person B.
yes,
When that business gets sold to person B, person A has to account for output on the sale of a going concern.
yes,
Okay? And that output that they have to account for on that sale of going concern, this is now person A. They
yes,
account for 100% instead of
yes,
70% of
yes,
output.
yes,
Okay? That is correct. Then we then say, because they've accounted for 100% of output, whereas in their business, they only supply 70%. That means
yes,
the output that they were previously not entitled to claiming, which is the 30%, we must then, what do we call it? We must then find a way of, I'm going to say, compensating them for that 30% that they were not
30%.
previously entitled to.
Yes, 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 yes.
Okay, and in order for us to compensate them for that 30%, we then apply section 16.3H,
380 is
which means
100%.
they're now entitled to an additional input.
Input, yes, sir.
Okay, and that additional input will then be to the extent of that 30%.
That 30%, yes. And
Yes.
then my question is, since now, let's say they were making 95%, and you said if you're making 95%, it is deemed that you're making 100%. Section 16.3H will not apply in this instance because that 5% was already claimed initially as input tax. That's what I'm asking.
Okay, so you are saying to me, this business that was previously making 70%
Yeah.
has now moved to 95%.
No, 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 no. I mean, in terms of if initially they were making 95% taxable supplies,
Uh-huh.
on day one, when we would claim input tax, it is deemed that you're making 100%,
Yes.
right? Now you're selling as a going concern. Section 16.3H will not apply to you because of that 5% was also claimed. So there's no compensation of the input tax now when you are selling.
Yes, okay, now I understand. Yes, now I understand what you're saying. Also, what you're saying is that a business that makes 95% taxable supplies is deemed to be making 100% taxable supplies, meaning that they can claim the full input on their expenses that they incur.
Yes,
Now,
sir.
when we sell that business as a going concern, we are required to account for output at 100%.
Yes,
However, we're not going to apply section 16.3H
yes,
because it was at 100%. It has always been at 100%, even though they are actually supplying at 95%. Okay, and my
100%.
answer to that is yes.
Okay.
Yeah.
Thank you.
Okay, any other questions? Okay, so no other questions. Then let's then look at the last one, which is in an instance where it's a sale of a going concern, but that going concern is making less than 50% taxable supplies. So remember I said this is one of the instances, the three exceptions where that output is allowed to be deducted. So not to be deducted, but to be apportioned. Okay, so let's look from the seller's perspective. So from the seller's perspective, let's say the seller is making 40% taxable supplies, meaning 60% is exempt. Now, the seller on what we refer to as the going concern portion, which is the taxable supplies portion of the business, they'll be allowed to charge VAT at a 0% on that portion. Whereas on the non-going concern, which is the part that is not zero-rated or that does not produce taxable supplies, they'll be charged VAT at a rate of 15%. Okay, so 0% on the going concern part of the business, which is the part that is making taxable supplies, and 15% on the non-going concern part of the business, which is the part of the business that is making exempt supplies. Now, if we then look at this, we have a business that is making less than 50% taxable supplies. But however, look at what has happened. It has been charged VAT at a rate of 15%. It has also been charged VAT at a rate of 0%, which means VAT has been charged on 100% of the sale of the going concern. That's why I said to you guys earlier on, you need to become comfortable with the concept that 0% equates to a number. This is a number. So that means there's a portion where 15% has been charged, and there's a portion where 0% has been charged. Whereas on a normal basis, they were only entitled to claim input to the extent of their taxable supplies. So now what then needs to happen is that they need to get compensated because VAT has been charged on 100% of the sale of this going concern. And that is why that is when section 3H then comes in. Then you claim additional input. That additional input is claimed to the extent of the non-taxable supplies. So the section 16.3H that we're looking at over here, A times B times C. So A being the tax fraction, B being the lesser of in terms of the cost, and then C being the, in our case here, C being the extent of the non-taxable supplies. Okay. Then when we look from the perspective of the purchaser, now the purchaser of the business will claim the input on the 15% to the extent that they'll be making taxable supplies. So if you acquire a business and you're going to continue making 40% taxable supplies, in the same manner when you acquired it, then you'll claim your VAT on that 15% to the extent of the taxable supplies. Okay. Right. Any other questions? Any other questions? Any other questions? Okay, I know it's quite a lot to take in, but I'm hoping that subsequent to this class, you'll take the time to go and digest it. And of course, there are more detailed videos that are available on this information. And so you can always reach out to the admin team or the caretaking team so that you can then discuss with them how you can get access to the more detailed videos. Okay, all right. So that's where I am going to stop with that because there's still quite a number of things that we can go through, but I think I've covered in essence the core of what I'd refer to as the VAT legislation for the purposes of what is examinable for you guys. And of course, the other things we'll talk about as we're looking at questions and so forth. All right. So I don't see any hands that are up or any questions that people want to ask. Okay, that's fine. So according to my watch, it's 12:25. I think let's do a 10-minute break so that you can really refresh before we jump. I think I'll just do one more section of the lecture, and then once we're done with the lecture, then we'll then get into the tutorial. Okay, so let's do 10-minute break, and then we come back and one more section, and then we do the tutorial.